Welcome to the Salty Investors episode number 37. It is Friday, June the 23rd?
Third. Yep.
2nd?
Third.
23rd.
Yeah.
Yeah, how are you this fine June Friday, Tim?
Yeah, just getting a bit balder, but, can't complain too much. What about yourself?
Yeah, no. Living my best life. That's what I'm doing down here.
Nice.
Yeah, but some people aren't. And so let's get to that. We'll get to the salt for the week. So my salt for the week is, as has become standard practice here, is to defend the RBA. This time it is the RBA Deputy Governor, Michelle Bullock, because she said that Australia's unemployment rate will need to rise to 4.5% to tame inflation. Now, that would be consistent with a loss of about 140,000 jobs, give or take, over an 18-month period. Of course, this sent the unions and, the Twitterati into a frenzy. And Stacey Chanel, acting National Secretary of the Australian Workers' Union, said that it's truly a broken system when the RBA's message to struggling Australians is some of you need to lose your jobs or we'll have to smash you with interest rate hikes. Now, of course, Stacey's socialism and economic illiteracy is showing here. Now, we don't need to get into what NIRU is, the non-accelerating inflation rate of unemployment, but basically, if you've got a really tight labour market where the demand for labour exceeds the supply, it's going to have upward pressure on wages, and you're not going to get inflation down. So you've got, again, this comes back to trade-offs. There's no trophy room. Not everybody gets a ribbon. You have to decide, do you want consistently high inflation with consistently high wage growth that trails inflation, you actually lose money over time, or do you want to get your inflation back down to the 2 to 3% range? Your choice. You can't have both. Stop pretending it's the system, because your solutions, which will be, socialism, is not going to work because it never has. Same old story, same shit, different week.
Yep. Yeah, well, it's a bit of a shame that people are still thinking this is a good idea, and we probably need to go through the pain again of working out that price controls and all this other junk that they think is a solution is all going to have to come back, I'm pretty sure. So
yeah, no, it's just like it's the same old thing. Like, yeah, raise the minimum wage. Okay, why don't we just raise it to 100 grand for everybody? 100 grand a year. Oh, that doesn't work. Well, why not? Oh, yeah. You have to think. You have to think past your emotional reaction on second order effects. Oh, yeah,
that's right.
No, that's too hard. That's too hard. I'll tweet something out in an emotional rage instead. Well done.
Yeah, and get the mob to go out there with their pitchforks and take on everybody, and feel resentful and the system's against you, and bring the whole place down. Oh, I don't know. Yeah. Just typical, the mob nowadays. But yeah,
Yep.
Seems to be they're gonna have to make a decision somewhere along the line here. I don't know which way they're going to go, but I think some jobs have got to go. Just to be blunt, we've had a great time, with all these jobs recently. So
that's it. Especially with how's that going to go with 700,000 net migration over the next 2 years. That's what it's being forecast.
Yep.
And you want unemployment to go up. I mean, a lot of those migrants are going to be students, but it's very easy for students to drop out of university and get work. Anyway, let's get on to your salt for this week. What do you got for us, Tim?
Basically, the South Australian government is thinking of doing some stuff to help out renters, and one of the ones is the eviction period. Instead of 30 days, they change it to 60 days. And also they're going to allow pets. And I'm just sick of explaining, the economic, reasons why, this isn't going to work. Now I'm fed up, and I'm just asking people, will this help housing supply or, not help it? It's just an easy question. Yeah. Will this help the housing crisis or not? And clearly this is going to discourage people from investing in housing. Clearly, if you're thinking about investing in property, you think, wow, it's getting tougher to do it. Maybe I'll invest elsewhere and, don't invest in housing. And then we get less supply, and then everyone's complaining about the cost of housing, and there's not enough housing being built, and you destroy the free market, and then you start complaining, and then you're saying, oh, we need, full communism now. Like, let's bring back full communism. That's what we need to solve the problem.
Yeah. Communism always works, didn't you know, Tim? Just have a look at history.
Yeah. So, but they just kill the free market with 1,000 cuts, and this is just another one that's just added to the list. And then they go, well, why don't you want to invest in houses? Why don't you want to build houses to help people? Like, So yeah, just getting a little bit cynical, But I'm just trying to simplify it for everybody. Will it help? Or is it going to hinder? So not getting responses, obviously, because people just want that little narrative that they want a free lunch and there is no cost. So
yeah, that's right. Yep, but they like to live in the world as they want it to be, not the world that is.
Yep.
They want it's like wanting to suspend the laws of physics, so that you can leap over tall buildings in a single bound. It's just that would be nice, but that's not the world we live in. Sorry.
Yeah.
All right, so let's get on to the economic noise of this week. So I'm starting a new segment on this show, and it's called Retail Death Watch. It doesn't mean I think these companies are going out of business. I don't think they're going to die. But I mean, this was of particular interest because Best and Less, this is their second profit downgrade. I think I've said lately as last week. Wait for the second downgrades. They're going to come. So this is their second downgrade in the space of a month. So last downgrade, they said that the profit for this half to June 30 would be between 10 and 12 million. That's down the bottom of the announcement there. Now it's going to be between 3.6 and 4 million. And there's going to be an impairment charge, which is, we used to call them abnormal items. They come with all sorts of names. Basically, what you should think of them as Warren Buffett said, is mistakes. Somebody made a mistake, fucked up, and they're going to take an impairment charge of somewhere between 1.5 and 3 million. So they're barely going to break a profit for this half. They're probably going to suspend the dividend altogether. They probably won't pay one. And this is just, I keep highlighting this because this is going to create some great opportunities for buyers down the line. Now, Best and Less is currently, it's interesting because the stock price hasn't moved because there is a buyout offer. It's not really a buyout offer. So Brett Blundy, who's the retail guru in Australia, he's put out an offer to shareholders to buy their stock. So it's basically control. He's not actually going to take the company private. It's going to stay listed, but that offer extends until the 27th of this month. So that's just next week. And once that offer's over, and I think he's got 2/3 or 70% of the stock at this point. Once that offer's over, I would expect this share price to fall out of bed. I mean, this is going to plunge through the floor. The offer price is $1.89, and that's about where the share price is now, of course. So, but yeah, I mean, this just watch this space. I mean, we saw the horrible numbers from DJs last week. We've seen the downgrades from Adairs, Baby Bunting, Dusk. The share prices are getting beat up. This is going to be an interesting area because these stocks they're already trading on very low PEs. Of course, their dividend yields are not believable because all those dividends are going to get cut. But when the cycle turns, whenever that is, your guess is as good as mine. There'll be some bargains here.
So is the board thinking of taking this offer, or there's just no talk? There's no...
So it's not really...
Or it's shareholders that actually had to make that decision?
Yeah, it's shareholders. So shareholders can just accept the offer and tender their shares, and which is better than paying some brokerage
you think,
to get
if I was a shareholder, you're thinking, profit downgrades, take the money and run. Surely.
Yeah, exactly. I mean, take the money now, and then you could buy the stock back next week for like a 20% discount. Easy,
Yeah. So it must be people just not know about it, or I don't know. They just think it's a blip in the road or whatever. I don't know.
Most of them do, but some people who own these stocks directly don't even take any notice, and they won't find out until after it's all happened. They'll go, "What happened?" Yeah. So
okay.
Yeah. I mean, Blundy's got pretty good track record of turning retail around.
Okay.
He's buying stock at $1.89. It's going to go way significantly lower than that. So he's comfortable with his price. So you got to look out 2 to 3 years, try to look through all the doom and gloom. It's hard to do. It's very hard to do. Easy
In reality,
to say, hard to do.
Yeah.
Yeah.
Well, you don't know it's 2 to 3 years, do you? Like you got no idea. Is it garden variety or no landing?
Yeah.
Exactly. Was it worse? So.
Yeah, I mean that's a strange thing here because Australia has avoided a recession for more than 30 years, a proper one, and we might actually get one. For a change. It might be like the 90s where the US had a very mild recession and we had a pretty nasty one, rather than the other way around. Anyway, watch the retail space. There's more carnage to come. Thought this was interesting. So this comes from Macro Business Guys. Now, bank credit fell again and has not risen in 11 months. Now, it looks on that chart like a tiny blip, but I mean, this is like retail sales. It very rarely goes negative, right?
Yeah.
I mean, just sort of up and to the left. Population growth sees to that. Up and to the right, sorry. And, you can see in the financial crisis, it just sort of went sideways and slightly down. And so what the point here is to say that this matters. I mean, credit is the lifeblood of the bloody economy. I mean, it's how things get done. It's how projects get started. And so this tightening in credit is significant. And I think it's not getting probably as much coverage as it should be, because it's fairly significant. I mean, that graph goes back to 1986, and this is really the only second sort of discernible downturn you can see outside the GFC.
Or even the COVID. It just went sideways. It didn't actually go down there, like it's still uptrending. So this is refinancing as well, I'm guessing. So must be refinance credit or straight up.
Don't know. I'm not going to. Not sure. You would think so if it's total bank credit.
Yep.
And this is just the year over year, and again, so you're approaching zero year over year growth in bank credit, which is only in the last 35 years that's only happened sort of the GFC. Every year you've seen year over year growth in bank credit. So if it's about to go negative, that's something to pay attention to. Can't emphasize enough how much credit greases the wheels of the economy. I mean, it's the way we run, Gone are the days when people saved money and then
capital,
cash,
put up your own capital,
what a waste of time that is. Just get some free stuff.
Leverage. Everyone, you can't run an economy without leverage. Yeah, so that's a bit. So M2 must be freaking falling off a cliff as well. Like I feel that's contracting here a bit. So,
But it's important. It's one of those things. I think that because we had the few banks that went out of business. A few runs on the banks and. It seemed like a crisis, and the crisis was averted, but that hasn't gone away. That was sort of the warning shot of a bigger problem, I think. Credit conditions. So this is just asking borrowers and corporate borrowers as well. Credit conditions look pretty shitty. That's the availability of loans compared to 3 months ago getting worse. Again, it was the worst in the GFC. And the one at the bottom is, do you expect easier credit conditions going forward? Well, the last reading is a -10, which is the worst it's been. They've only got 5 years of data there. So credit's getting harder to get as well as contracting. So, it's just one more sort of nail in the coffin.
I see Howard Marks memo or his team put out one, and they're like rubbing their hands together going, finally we'll be able to, this is their area, they're finally getting this yield. Like, so
this is what they love. This is what they wait for. Yeah. go in and have a look at all that distressed debt and just throw out the ones that are too risky and buy the other ones. Yeah, I mean,
Yeah, they're saying even European stuff, you're getting 8-9%, on
yep.
Highly rated stuff. Like no one talks about this stuff anymore. Like, well, it's all equities, but yeah, that's coming back into vogue. I think
yeah, it's too boring for a lot of people, right? I mean, it's just corporate credit. Who does that? Yep.
Yeah, the serious people there. But Howard Marks, he's like, yeah, I'm sure he'd be looking forward to this period. Like he's going to actually get a few chances here to deploy some serious cash. So,
yep. Yeah, so I guess the upshot is the no landing camp that narrative's in danger. Yeah,
yep.
No landing as opposed to who knows if it's soft or hard, but I think no landing, we might be able to take that off the table. Who knows?
Yep.
Let's get on to UnitedHealth Group. What do you got for us, Tim?
Well, yeah, UnitedHealth Group is something that we don't normally look at. But since the market's rallying really hard, even with interest rates rising, I thought I'd look elsewhere. Medicare costs have increased, so UnitedHealthcare is down 9% over the last 12 months. UnitedHealth is basically a health insurance company. It's the world's 11th or 10th largest company by revenue and the largest healthcare company. They've been around since 1974. And they did well after political donations, helping Obamacare get passed. So
yeah, well, look at that stock price since 2010. Jesus Christ.
Yeah, so it's up 1,400% compared to a pitiful 250% for the S&P 500. Who said political donations don't pay? Look at that.
Who would have thought?
Yeah. And now Republicans are not going to get rid of Obamacare, and the economies of scale. Like it's going to be really hard for new people to enter this market. So earnings are forecast 10% a year and growing at 18% over the last 12 months. Analysts have it underpriced by about 20 to 30%. They're buying back stock. They've got a good dividend yield. Price to free cash flow, hasn't been this good for a long time. You look at the return on invested capital and margins, they're not, brilliant, but you're getting a more, terrible. But you're getting a more run-of-the-mill type, stable type, defensive type option with this. If we flick over and look at the balance sheet, they've got, nearly 40 billion of debt. This is a very large company, obviously, and, but they've got like 34 billion in free cash flow coming in. Right. So, there's no problem there. Like, it's a large number, that sort of freaks people out. But, look at the total assets. They just keep increasing and increasing. They're just dominating. It's just one of these, the government mandates something and it's just hell for anybody to compete against it when you're this big, because you just got a team of compliance officers, 50 of them. Doesn't matter if you add an extra 3 or 4, but if you're a new business trying to get into this area, it's impossible. There's just no way that you could go, let's go start a freaking healthcare insurance company. You're freaking crazy. I don't see it changing anytime soon. It's not that expensive. It's a bit of growth, but you're not going to get very much growth here. Yeah. It's a bit too defensive for me personally, but we should be keeping our options open.
What the share price has come off because the investment returns on the float have been poor, or what?
Well, theoretically that'll increase, but as they lock in higher rates, but it's just the Medicare prices that they have to fund out. Hospitals, inflation and everything has gone through the roof. Right. Wages and that. Imagine what a wage is going to be for all the staff and everything that you have to pay for a medical procedure. It'd be astronomical in the US. So everyone's, Medicare costs are going crazy, but like they don't have like a social system like we've got in Australia. So a lot of companies, they help pay for, this is included in your salary package. So that's why they get these economies of scale that are so huge. So there's new people come on all the time. Yeah. So just Obamacare, all the libertarians out there just are crying because, you know, look at this, like 1,400% versus 250 for the S&P, you know.
Right.
So, you know, political donations do work, you know, and
Mhm.
the Republicans don't even talk about it now. It's like off the cards. This is locked in. This is basically locked into the US economy now. I can't see it. You know, it's got a moat around it now. Like, it's pretty hard to disrupt it now. It's been left too long. Just
Yeah, well, I
very,
mean, the Republicans didn't even have a plan to repeal Obamacare. They said, remember, the catch line was repeal and replace. Well, the repeal part they had down because that's pretty easy to do, but they had nothing to replace it with. They didn't even have a plan. So
yeah, it's just all talk. You know, trying to talk tough, but yeah, it's in now, and the results are crazy. So, but it's in the top 10 companies in the S&P 500.
Right.
And no one really
in market cap size, you mean?
Yeah. And no one really talks about it. So I thought, you know, I'll give it a little bit of love. It's not something that, you know, just the margins and the return on invested capital, bloody hard with this amount of assets. You know, look at the assets, 250 billion assets. You know, it's bloody hard.
Why is there no gross margin number there?
Yeah, I don't know, but
you see how to figure it out. Operating margin's not. Yeah, it's not great, is it? But yeah, I guess that's the nature of their business, isn't it?
Yeah. So you're sort of getting the Costco type, you know, lock in. Obviously, not as nice, but this isn't going to go anywhere. Like, you look at 10 years, people still want healthcare, and they're going to want the lowest cost healthcare that they can get, the best value, and this is it. So sort of like Geico, you know.
Yeah.
Geico is a very similar type model. You know, everyone wants car insurance, but they don't want to pay a whole heap for it. So Geico was the lowest cost provider. And that was their moat. So it's very similar, but how much can this grow? I think we've had a pretty good run for 10 years. That's all. Since Obamacare. So, but still, you know, if you're looking for something defensive and you want a bit of a dividend, this isn't too bad. But it's just hard at the moment. What do you invest in? Like if you had money to deploy, what are you going to do? Like, you're stuck. So,
yeah. All right, there you go, ladies and gentlemen. UnitedHealth, and that's the stock for this week, and we'll see you next week.